Evaluate the choices of short-term funding available to a company and recommend a financing method. It's important to remember that although a company's goal of maintaining a sound liquidity position is central, and we can use liquidity ratios and cash forecasts to measure and assess the company's position, how they achieve the best results requires some further thought. One major factor which is often a shortcoming of a company's cash management policy is a detailed knowledge of the various available sources of short-term financing. For example, from a bank, they might consider a line of credit, a banker's acceptance, or factoring. In terms of non-bank options, we might consider partnering with a financing company, or we might consider issuing commercial paper. Okay, let's talk in a little more detail about lines of credit. An uncommitted line of credit is where the bank offers to lend short-term funding to a large, generally financially sound company. The word uncommitted implies that the bank has the option to pull the plug if the circumstances of the borrower changes significantly. A committed line of credit or an overdraft line of credit means that the bank, to some extent, are locked in to lend some amount up to the credit limit for some pre-agreed period of time. This gives the borrower some level of assurance that funding will be there if they need it, even if they get into financial distress, but that assurance, the bank's willingness to commit, comes at a price. A revolving line of credit then is a further commitment by the bank, typically in terms of the length of the loan. Revolving lines of credit generally imply loans up to and including terms of more than a year. Now, when a company seeks a line of credit, it is possible that the bank will require certain preconditions. For example, the bank may seek some collateral, some asset or assets of the company to be pledged to guarantee the credit. This might mean inventory or receivables or fixed assets in some cases. The bank may also want a blanket lien, meaning that the bank has some claim on all current assets and future assets of the company in the event of a default where the original collateral was insufficient. Moving on then, a banker's acceptance is all about exporting goods. When a company has shipped goods internationally, they may receive a guarantee from the buyer. This guarantee, the banker's acceptance, written by the bank of the buyer, is basically a note to say that the buyer will pay once the shipment arrives. If the selling company needs immediate funding and they cannot wait for the shipment to reach its destination and the subsequent payment, they may choose to sell on this banker's acceptance at some discount. Factoring is another term used to describe the direct sale of receivables. Generally, receivables are sold at some discount from their face value based on time outstanding, creditworthiness of the customer, and the firm's history of collection. Moving on to the non-bank options then, we might first consider financing companies. These companies offer short-term funding, generally at premium rates, and these higher rates are accepted by companies who cannot access short-term funding through a normal channel from a bank. Following that, a company might consider issuing commercial paper. This is a practice generally reserved for large, highly creditworthy, stable companies. Now, they may choose to place or sell the paper directly with investors themselves or through a dealer. It's common that the rates of interest paid out on such a paper would actually be less than that charged by a bank.